Welcome to This Explainer. We're diving straight into how a single geopolitical choke point is literally sending shockwaves through the entire global economy. This is a fast-moving situation, and we're going to unpack exactly how distant global geopolitics connect straight to your everyday expenses and your investment portfolio. Okay, let's kick things off with this jarring number, 5%. On Monday, August 10th, crude prices jumped by roughly 5% because uncertainty around the Strait of Hormuz suddenly hit a boiling point. Now, in the energy world, a 5% jump in a single day isn't just a minor fluctuation, it's a massive earthquake that forces everyone from Wall Street traders to central bank policymakers to immediately sit up and take notice. And this sudden spike leaves investors and consumers all asking the exact same critical question: could this trigger a new inflation shock? We really have to wonder, are we just looking at a temporary blip, a localized panic, or is this the beginning of a sticky, prolonged inflation story that will fundamentally change the outlook for global markets? To understand why this matters so much to your wallet, we just need to follow the dominoes. Step 1, oil spikes. Step 2, inflation rises. Step 3, the Fed shifts rates. And Step 4, we see massive asset volatility. Section 1, the trigger, oil and the Strait of Hormuz. The Strait of Hormuz is arguably the world's most critical energy bottleneck. Right now, markets are intensely watching the stalled negotiations between Iran and the United States. Because hopes for a full reopening have basically evaporated, it's slapped a massive risk premium on crude oil. Traders are terrified this route will stay disrupted, so they're paying up right now to secure supply. Actually, you know what? A physical shortage doesn't even need to happen first. Financial markets are reacting violently just to the pure possibility of one. Section 2, the first domino. Inflation. So how does an overseas disruption actually bleed into everyday life here at home? Well, energy isn't just the gas you put in your car. It's the foundational cost for absolutely everything. Think about the massive invisible logistics network behind our daily lives. Trucks need diesel to drop packages at your doorstep. Cargo ships require heavy fuel. Airplanes need jet fuel. Factories run on massive amounts of energy, and even growing our food relies heavily on machinery. When crude gets more expensive, all of those underlying costs start to creep up right along with it. So suddenly, businesses are facing an impossible choice. Do they eat those rising energy costs and completely crush their own profit margins, or do they pass them on to consumers? Spoiler alert, historically they pass them on. And if businesses push these costs onto us, prices go up across the board. This is exactly why the markets are sweating the upcoming Wednesday, July Consumer Price Index report. Everyone wants to see if this energy spike is already bleeding into everyday sticky inflation. Section 3, the second domino, the Fed's dilemma. This brings us to the Federal Reserve, and they are facing an absolute nightmare scenario right now. Look at this comparison. It's a classic rock and a hard place. On one side, we have surprisingly weak jobs. July payrolls actually fell by 23,000. Normally, weak jobs demand lower interest rates to stimulate the economy. But on the flip side, soaring oil prices threaten to push inflation significantly higher, which demands keeping rates high to cool things down. Weak jobs demand one action, high oil demands the exact opposite. If the Fed gets this balancing act wrong, we risk stagflation. That is a dangerous economic condition combining higher inflation with weaker economic growth. It's the ultimate damned if you do, damned if you don't trap. If they cut rates to fix the job market, inflation could explode. If they raise rates to fight inflation, they could crash the fragile economy into a severe recession. They have virtually zero good options left. Section 4, the asset ripple, stocks, gold, and crypto. This entire policy dilemma dictates the flow of money globally. Let's look at how assets are reacting. Stocks are getting pressured. Gold is surging as a safe haven. Crypto is facing wild volatility as investors try to guess the Fed's next move, and the US dollar is strengthening. Looking specifically at equities, the hit was immediate. Broad U.S. stocks moved lower. The S&P 500, NASDAQ, and Dow all slipped. But under the hood, it is a totally mixed bag. Energy producers, they're making a killing off the higher prices. But companies that rely on affordable fuel like airlines and shipping are getting squeezed incredibly hard by those rising operational costs. We also saw the U.S. 10-year Treasury yield climb to about 4.697%. Why should you care about this specific yield? Because it effectively dictates borrowing costs across the entire economy, from your mortgage to corporate debt. And when yields go up, stocks, especially technology and high-growth stocks, become much less attractive to investors. Meanwhile, investors running for safety have pushed gold to its highest level since early June. Gold historically loves geopolitical uncertainty and inflation fears. Plus, if people think those weak jobs might force the Fed to cut rates anyway, that makes holding a non-interest paying asset like gold a lot more appealing. But a quick caveat for sure. If the US dollar keeps strengthening, that could eventually put a heavy lid on gold's upward surge.
Section 5. The final domino. The global economy.
Let's zoom out, because this energy shock doesn't just isolate itself in the US. The US dollar index rose around 0.20% to approximately 99.80. A rising US dollar basically acts as a massive transmission line, literally exporting our economic stress right across the ocean to the rest of the world.
Here's why that's so critical. Crude oil is priced in US dollars. So when the dollar strengthens, oil becomes devastatingly expensive for other countries in their own local currency. Emerging markets and major energy importers, like India, face a brutal double hit. First, the crude itself is more expensive. Second, they have to buy it with their own weakening currency. That drives up their trade deficits and imports massive inflation straight to their local gas pumps.
Section 6. What investors should watch next. With the global economy totally on edge, here are the 5 indicators that will dictate the market's next move. First, any headlines out of the Strait of Hormuz. Second, the upcoming July CPI inflation data. Third, expectations for the Federal Reserve. Fourth, those bond yields. And fifth, and this is absolutely crucial, oil's duration. As the source material points out, a temporary spike is manageable, but a prolonged energy shock is much more dangerous. The real threat isn't just how high oil goes today. A spike for a couple of days won't break the system. But if crude stays elevated for weeks or months, major companies will start permanently adjusting their consumer prices to survive. So I leave you with this final thought. How long will oil stay high? If this crisis fades swiftly, global markets dodge a huge bullet. But if this is just the beginning of a prolonged inflation story, it could permanently force the Fed's hand, leaving them with incredibly few options. Keep a close eye on these indicators, because the next few days could easily set the trajectory for financial markets for the rest of the year.